Is stock market overvalued and about to crash? Nobody knows that. But should you stop investing and wait it out? The answer is no. And let me tell you why. Hello everyone, Alex is here. I hope you're doing well. I hope you're staying safe all the time. Stay safe. And today's video is going to be crazy. I'm going to tell you what's happening on the stock market right now. Is it overvalued? Is it undervalued? And where it is going in the future, what are you supposed to be doing, and how to invest and make money in these conditions. And I'm gonna be looking at US stock market specifically because it's the biggest, the largest stock market in the world. And if you wanna get some information what's happening with the stock market in general and where it's going and all that, US stock market is the best place to look at. Also, before we start, don't forget to smash that like button, subscribe to my channel, hit the bell so you're not missing out on the future of these videos, and it's gonna help my channel as well. So the first thing you want to do when you're analyzing the stock market and if it's overvalued or not, you need to determine what does it mean for a stock market to be overvalued. Let's take a look at a single stock and see what does it mean for a stock to be overvalued. And one way to do it is to look at the PE ratio. It's a price to earnings ratio. So the PE ratio is actually the most common used metric when it comes to investing. The earnings multiple reflects the current price of a stock in relation to the earnings of a company in a quick and easy understandable way. And the formula to calculate the PE ratio is super simple. You need to divide the current share price of a stock by the earnings per share metric. And all of this information available on the stock whenever you're looking at their metrics. And even after we calculated the PE ratio, what does it mean for us? What it actually tells us, right? So what are these numbers? According to Investopedia, the average PE ratio for S&P 500 index is actually around 13 to 15 historically. However, right now times are a little different and there were a lot of tech stocks actually added to S&P 500 index, so the PE ratio is actually considerably higher than it used to be historically. For example, let's take a look at Facebook. Should I delete my Facebook? That's a good question. Anyways, and the average PE ratio for Facebook for the last couple of years has been around 28 to 30. And in the first quarter of this year is actually at 29, which is 2 times higher than the average S&P 500 index PE ratio historically, which is crazy. Another great example is going to be Apple, which everybody knows about, and it's the largest, the biggest, the most expensive company on the stock market, and it represents a huge portion of the S&P 500 index as well. They also have a PE ratio for the last couple of years at around 28, which is crazy number, again 2 times higher than just the index itself. And the final example, which is going to be even crazier than this, is going to be our favorite stock, Tesla. Hello Elon, yeah, I'm going to be talking about your company, and sorry about that. The current PE ratio for Tesla right now is around 400. It is 26 times more than the historical S&P 500 index PE ratio. And what exactly all these numbers and all these examples actually tells us. So if you look at the S&P 500 and diversification of this index, where the stocks are coming from and all that, you can see that tech represents 30% of the entire index, which is a lot. It means that the big portion of the index itself actually represented by tech. And the PE ratio for tech is actually considerably higher compared to the other industries. Today, the index is actually heavily weighted into tech, 30%, healthcare, and consumer discretionary stocks. Meanwhile, there are not a lot of utilities or real estate stocks or companies who are involved in producing or selling raw material. I want to also highlight that the sector distribution within the S&P 500 index actually wasn't all the time the same. Changes actually drastically year over year. And if you look 25 years back, you'll likely see far fewer tech stocks and more of a consumer discretionary or communication companies within the index. And if you go 50 years back, the index and the sector distribution is going to be way different as well. And you need to understand this, that the S&P 500 index is not always the same, right? It's not the same stocks, it's not the same sectors, the distribution always changing. And whatever was important and whatever was performing actually 10, 20, 50 years ago, it is not performing today, but the other sector is. For example, in 2015, the consumer discretionary sector was actually the top performing sector, right? And then in 2017 is actually ranked third. And then in 2019 is actually ranked seventh, right? So it's different sector performing better or worse every single year. Another great example is that the communications sector was actually ranked the worst one in 2017. And it was actually ranked the top second one a year earlier. This is crazy how all this shuffles, and it is so hard to predict this from the consumer perspective. That's why it's so hard to time the market, and you need to diversify your portfolio to make sure you're always covered with all different sectors. So that's about P ratio and S&P 500 index that you need to understand, and you need to know what's happening and why the P ratio is so high for this index and what probably is going to be happening next if the index starts shuffling their sectors in a different direction. And this is probably going to happen, but nobody knows until it actually happens. The second great material to look at for understanding if the stock market is overvalued is actually consulting with the super nice experts like Warren Buffett. And of course, I can just call Warren and ask him what's happening. Hello, Warren. What is happening with the stock market?
Hello, Alex. The stock market is overvalued, but keep investing.
Thank you, Warren. See you later. So the Warren Buffett says, and just told me on the phone live with this video recording, that stock market is overvalued, but keep investing. But now let's see for real how we can actually ask Warren what's happening. There's a thing such as Buffett indicator, which probably gonna tell us what Warren Buffett actually thinks about stock market. The Buffett indicator is actually the ratio representing the total value of the US stock market to GDP. Current ratio stays at the 159%, which was seen last time right before the dot-com bubble. Does it mean we're gonna crash tomorrow? Probably not. Does it mean you need to keep investing? Yes. So according to Warren Buffett, he just told me on the phone, and also the Buffett indicator we just looked up, the stock market is overvalued. And finally, does it mean we need to sell? Does it mean we need to stop investing? What are we actually supposed to be doing right now? The short answer is no, you need to keep investing, as I told you at the very beginning of this video, because I want to tell you the answers right away. But the long answer is, and why you need to keep investing, because historically, the S&P 500 index actually performed at 10 to 11% every single year on average. Since the beginning, since the start and the birth of the S&P 500 index. And it's been almost 100 years since the S&P 500 index been created. And of course, we've seen the stock market crashes and recessions and these crazy things happening throughout the years. But if you live through that, and if you keep investing during the market crashes and before that and after that, and didn't pull out your money, and your emotions didn't drive your actual investment decisions, then you probably stayed on top of the game. And also keep in mind, it is impossible to know when the stock market is actually gonna crash. Nobody knows that. It's just gonna happen one day, and it is going to happen, because this is the normal thing for a stock market, to go down, to go up, and you have no idea how to predict that. There is no way you can do it. But there is something you can actually do. You can stay invested so you don't miss out on the best stock market days. For example, look at this chart. If you invested $10,000 into S&P 500 index in December of 2005, and you keep and you hold it until December 2020. So if you stayed fully invested, you would earn $41,100 since then. So 10% annualized total return. This is what stock market was doing. But if you missed on the 10 best days, you would only earn 4%. If you missed 20 best days, this is 0.8%. If you missed 30 best days, it's actually negative, minus 2%. And if you missed 40 best days, it's actually negative 5%. And this is crazy. So you shouldn't predict the market. But many will argue otherwise, and many will do their own thing, their own predictions, and try to time the market. I'm sort of on the other side of things, where I don't want to predict the market, I keep investing, and I follow the Warren Buffett's great statement. Time on the market will always beat time in the market. Stay safe out there, keep investing, and I'll see you around. Cheers, bye.